What do most Indian consumers want? The answer may well be affordable products which fit their monthly budget. And that is why, in the world of the Indian FMCG sector, most companies survive on thin margins. And for foreign retailers, the country has been nothing short of a graveyard. French B2B major Carrefour, Walmart, Amazon all failed to grab a foothold in the traditional Indian market. And the recent casualty was German retailer company Metro AG. Last month, it completed the sale of its India operations, including all 31 wholesale stores and the entire real estate portfolio, to Reliance Retail Ventures, a giant which has been aggressively expanding its presence. And, of late, it has been in consolidation mode. Soon after the takeover of the Metro's India business in May, Isha Ambani-led Reliance Retail retrenched between 700 to 1,000 employees from the JioMart business-to-business vertical. Reliance JioMart could lay off anywhere between 9,000 to 10,000 members of the wholesale division's 15,000 workforce in the near future. That is what a recent report in a financial daily claimed. Reliance Retail has started reviewing the roles of employees from other verticals too, and hundreds have already been put under a performance improvement plan. But apart from the immediate Metro AG trigger, what could be the reason for possibly opting for a larger round of layoffs, particularly in the B2B vertical? Well, the numbers don't tell us much. Reliance Retail, which puts out consolidated numbers, reported a 13% year-on-year rise in net profit at about 2,400 crore rupees for the March quarter of FY23. Revenue from operations at the country's largest retailer increased about 21% year-on-year in quarter 4 to about 61,500 crore. Its net profit for FY23 was about 9,180 crore rupees, up 30% from the previous year. Still, experts believe that the reason could be that JioMart is now hoping to improve margins and cut down losses in the wake of the price war it had engaged in recent years in the grocery business-to-business space.
This was waiting to happen, and we could see further consolidation in coming months as well. The company JioMart is presently focused on reducing losses and improving margins, as the company with its deep discounting measures promoted a distribution war. And with the massive expansion in chain of stores to approximately 18,000, there are discussions to rationalize some of them as per business potential. Over the longer term, the company is focused on maintaining a leaner team covering all major areas of opportunities to capitalize on the business growth.
The B2B business is a thin margin trade and requires multiple levels of cost optimization. Reliance Retail shall leverage the Metro network for a vertical push into B2B networks for synergies between the JioMart and the distribution business. Given the importance of distribution and back-end integration for any retail business, it is an essential step for Reliance to be able to capitalize returns on the investment via enhancement in smooth supply chains, negotiation power in distribution, and providing the best products and experience to the end customer.
But Reliance Retail's presence spans retail, wholesale, offline and online. So, even though these layoffs may not be limited to the B2B segment and may occur across the retail business, why is it important for Reliance Retail to focus on and consolidate its JioMart business-to-business vertical in particular? JioMart is Reliance Retail's online commerce platform, and JioMart Partner, which sells FMCG and general merchandise in bulk to retail stores, offices and hotels, is its B2B division. It may not be the biggest or even a profitable vertical, but it is still a crucial part of Reliance Retail's plan for breaking into the group of top 10 retailers globally. One of the necessary conditions for this would be to capture a larger than before portion of the Indian middle class. And since 80% of the Indian market is still what the industry describes as traditional, after accounting for modern retail and e-commerce, Reliance set its sights on entering the segment and partnering with smaller stores by offering them competitive wholesale rates. Experts say its strategy was to move beyond a pure retail play and instead establish end-to-end control of the retail ecosystem by controlling everything from wholesale and supply chains to e-commerce and payments. So, while the recent developments have to be seen in this context, what does the road ahead for Reliance Retail look like?
The company went aggressive in opening stores, which now they appear to have slowed down upon, and also there has been a slowdown in the hiring as well. With a changing landscape of business dynamics and with digital disruptions, with each passing day, no one can lay claim to everlasting business model. However, having said that, Reliance Group companies such as Reliance Retail or JioMart are well placed to reap the benefits of India's growth story. However, the companies will have to be well prepared in case recession hits the West, because that can definitely act as a dampener to the line of business. So staying alert, expanding on need basis, and staying thrifty hold the key for these companies given the massive cost built into them.
According to global brokerage Bernstein, Reliance Retail has expanded its market share in Indian retail from 1.8% in FY18 to 3% in FY23. Clearly, there is room for growth considering Alibaba's example, which reportedly controls about 17% of the Chinese retail market. Against this backdrop, while Reliance Retail is well posed to make gains, experts caution that it must keep a lid on the cost of expansion despite its deep pockets.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She'll soon be quoted on the front page. Business Standard.